You need to know what you're trying to offer and does it fit what the person wants. And if you do that to the next level, then you can target very specific profiles.
Greetings, everyone. Welcome to the exclusive Nobody Studios live stream show. My name is Sejal Thacker, and I'm your host for today's discussion. And as we all know, when you're navigating the current economic scene, it could be a little bit tricky for startups, especially when the venture capital funds aren't flowing as freely, right? So today's live stream is a perfect opportunity for founders and entrepreneurs out there to get some fresh, innovative fundraising strategies that work even better than even when the economy is throwing us all these crazy curveballs. So to shed light on this important topic, I would like to welcome back our Chief Nobody, Mark McNally. And we have a special guest joining us today, our Chief Incubation Officer, Barry O'Reilly. Welcome, you both.
Great to be here. Thanks, Rachel, for having us.
Awesome. Well, let's jump right in. So, obviously the topic for today is talking about startup funding, and it's evolved a lot in just the last year. There's a lot of economic things going on, technology, societal factors. So, Mark, maybe you can kick off the discussion with talking a little bit about just some of the trends that you're seeing with regards to startup funding.
Yeah, I'd say that, first of all, the biggest one is just, in the last 5 or 6 years, you saw traditional VC funds grow significantly in size. And so to give the audience perspective, when I started my career 27 years ago, a decent sized VC fund might be $100 million fund. And now you're seeing VC funds raise $3 billion funds. And there's a few that are, 10 times bigger than that. There's some crazy sized funds out there. But there's like a trickle down effect. So you now even a mid-sized fund that might be their second or third fund within a family is raising $300 to $500 million as a target. So you have a lot more capital within a specific fund. The domino effect of that is that it used to be a VC would be like one check of many. So they'd say, we really like this deal. It needs $10 million. We're going to put in 6, and we need 2 or 3 other people to kick in the 4. So there was a lot more of a village kind of community approach to funding that left a lot of room for a large VC to lead a deal and lots of other smaller VCs to piggyback. It also left a lot of room for ultra high net worth individuals or family offices to join VC deals as part of like a syndicated group. What happened is you started to see much larger rounds be created. If a VC likes a deal, one of their biggest challenges now is to deploy all that capital. They have to, deploy all that capital in the same time frame as before. So the effect is they're just writing bigger checks. They're driving valuations up, but they're also not reaching out as often for syndication in terms of offering other people the ability to participate because they have the capital and they're actually trying to deploy it. So one of the trends I think you're seeing is you have a whole new wave of micro VCs. Family offices are getting a lot more involved in direct investments where before they wouldn't even really consider that unless it was a pet project from one of the family members. Yeah, just an emerging category of kind of super angels and ultra high net worths that are striking checks directly at fairly large later stage stuff versus just kind of early stage angel stuff. So I think it has changed the landscape quite a bit. And there's a much broader group of players at the table. The other thing, again, comparing my career, but really in the last 10 years, I think the rise of the international investor is a real thing now. So you've got different regions, different emerging markets, again, family offices, it could be VCs, governments, sovereign wealth funds used to be, they would only invest in the biggest VCs and they'd only invest in the biggest, kind of plays. And now you're seeing sovereign wealth funds, which are government, essentially government investment funds, getting a lot more involved in startup ecosystems, but also seeing the ability to drive ecosystems within their own market. So yeah, I just think it's dynamic. It's constantly changing. There's a lot more players than ever before. And then you add into that even crowdfunding and the emergence of the smaller, maybe non-accredited investors. So I think it's ripe with a lot of opportunity. There's probably more places to raise capital than ever I've seen in my career, which is a good thing for startups. It's a good thing for investors, but it still changes a lot of things in flux.
Yeah, and I know one of the things that you and I have talked about on prior live streams is about how corporations are actively participating now in startup funding, right? And we've talked about how these investments are not only like a way to just get the money or the capital to the startup, but also that market access, that expertise and resources that they already have, right? So that they can also help the startup with those resources as well. So Barry, I would love to hear your thoughts on the current market dynamics.
Yeah, it's always an interesting time, right? I like what Mark's talking about the different ways that you can start to source capital, but also the different people that are starting to become venture investors. One of the things I think is most unique and proud of for what the studio did is when we ran our equity crowdfunding campaign, we got 1,000 investors in 55 different countries around the world, and over 50% of those investments were $100 or less, right? So that's people who drive buses, work in cafes, and now they suddenly have this opportunity to own early stage companies and own a piece of the future that really technology is starting to build. So again, that's something I think we're immensely proud of, that we created that opportunity for new people to start participating in this system. And it is evolving rapidly, right? Like you see more and more interesting ways that companies can raise capital. I think Mark talked about this idea of maybe, venture capital sort of 1.0 was really a lot of entrepreneurs that had success in the sort of their time. They started to have excess funds that they could deploy in other entrepreneurs and start investing. And that's really how the venture capital sort of world started to begin. And then we've seen this sort of next version of that, where those companies or funds or firms have just got so massive now that they almost have too much capital deployed. They have a concentration of it. And then even like looking ahead, you're starting to see all these very fascinating emergent ways to raise capital. Equity crowdfunding is a good example of bringing a group together, but you're starting to see this in, DAOs, which is distributed organized organizations, where people are using cryptocurrencies as a way to sort of create funds to invest in ideas that they believe in. And probably one of the most famous ones was, there was an opportunity to buy a piece of the US Constitution, and a group of people organized online and created a DAO and basically, pitched to buy a piece of that because they believed in something together. So there's a lot of these very sort of interesting and emerging patterns starting to happen. I still think, though, especially in the current market, there's a couple of things that will always come down to what investors get excited about. And that's having a compelling vision for what your business is, a great team to understand it, can they execute on it, a very clear plan, and then the network that goes around it. So when we think about Nobody Studios, one of the things that has made us very successful is we have a very bold, big vision about what we're trying to achieve. It's something much greater and bigger than ourselves. Investors look across our team and they see a leadership group that have had, multiple exits, almost $17 billion in exits, 75 startups between us. It's a huge amount of experience. And then we're working with early stage founders who, again, are top quality people who are experts in their own domain. Part of our development process, Progressive, where we're, have this very rigid, tough level of expectation about how ideas have to go through the development process before they get their next tranche of sort of micro funding that we offer in the studio. Again, if they see resiliency and they see speed and they see great execution, so that gets them excited. And then really from the network point of view, it's not only just this great group we've brought together. There's sort of 125 angel investors in this business. They're all active. They all have networks. They all have contributions that they bring through our advisory boards or ways that they can help us actually build companies through unfair advantages and relationships in their network. So these are sort of the things I keep mentioning to startups. They're really, really important. When you're going out there to fund, you really have to have that compelling vision. Make sure you can demonstrate why your team has the excellence to deliver on a plan that you've really built out and robust and can see real traction and profitability early. And then the power of your network, what's some of these unfair advantages that you can bring. And, we do that not only for the studio, but every single one of the companies that we're building within the studio. And, that's been a huge help for us as we bring our companies to market and get them funded.
You just gave us a whole lot of information, right? And so I just want to take you back into something you said that really caught my attention. There are so many different ways to raise money, right? And you started talking about this a little bit, but when I was posting about this on LinkedIn, somebody said, well, we've got traditional VC, we've got angel investors, we've got crowdfunders, but how does a founder decide what is the right way for them to, which way should they go about raising money for their startup? Can you talk a little bit about maybe the pros and cons of each of those?
Yeah, so look, there's lots of ways to do it, but the way we sort of come at it in the studio is we sort of have, I think, if you would consider like a product mindset about everything. One of the things we think about even in the studio is we have this strategy called our machine to machine strategy, which is the idea that we have a bunch of capabilities that we need to build in the studio to offer entrepreneurs. And if we need those capabilities, you sure as can bet that a whole load of startups in the ecosystem need those capabilities. So we flip them to companies. And actually, Fundco is an example of that. Now, when we start to think about each of these individual businesses, we don't just sort of run through a list and say, oh, your 4 options are angels, VCs, family offices, crowdfunding. We actually start thinking about what is this business's purpose? What's it trying to achieve? Who's its target customers? What are the kind of network that company is going to need to have? And then who could be the ideal investor profile to match with this ideal customer profile and the business's profile itself? So we're really systematic about how we think about this. So it's not really just a case of like walking down the list and going, oh, you want to choose angels if you like to get people who care about early stage businesses and just want to get involved, or you have to go to VCs because that validates that you're a real startup, right? It's really been very deliberate, and we take a lot of time to think about this. Who are the ideal investor profiles that are going to believe in the vision, that can augment the team, that can actually give feedback and challenge the plan, but then also have the network, if you will, to bring that business to its potential. So that's how we tend to think about it. And I'm sure Mark has a few thoughts on this too as well.
Yeah, I thought that was spot on. I think that it has a lot to do with what are the goals of the organization and what are your capital requirements. I think it's one of the things that's super important. Some companies, you don't need to raise a lot of capital before you can get to a really meaningful proof of validation or, market growth. And so you're always trying to, in the perfect world as a founder, you're trying to optimize your funding, right? Which means you want to raise the most money when you have the highest valuation. And that's one of the reasons why, you try to bring in a little bit, but that's enough to kind of get the product in the market and maybe get first traction. But some companies aren't like that. If you're building a company that's going to require you to be in build and R&D mode for 2 or 3 years, that's going to take you to a different type of capital. So to hire those types of folks, those types of engineers or scientists, whatever, they're going to work 3 years on something, you need to be able to point to a larger source of capital. And so I think the type of business you're building could point you into the kind of capital you need to go find as well. But if you have an ability to get some early traction and then raise more at a later stage at a better valuation, then that kind of takes you down traditional, get me an angel, get me a seed stage. That leads me to more professional capital. Some companies are focused on, hey, if I have one of these 4 partners in the market, that's going to be the success. Well, you're down to a couple of linchpin kind of deals. Maybe that's your source of capital to start with, just make sure that you've got success. So I always think that you have to take the company's focus and strategy into consideration when you're actually, sourcing capital.
Yeah, thank you, Mark. I agree. I think it's the key, right? To look at what resources you need to support your growth, right? So you can innovate. So let's talk a little bit then about what are investors looking for today? Mark, can you share some other factors that you see that investors are looking for? And and Barry talked about our equity crowdfunding campaign. So maybe you can talk a little bit about what were some of the things that we did right, because that was a pretty successful campaign that we did.
Well, to go back to my last comment, you have to look at the strategy of the organization to tell you where to get capital. Crowdfunding can be a lot of effort, and it's just not always the most efficient place to raise capital, because in our case, it was like everything we were focused on for like 5 months. I found it incredibly rewarding. All the founders found it incredibly rewarding because you're talking to people who wouldn't have an ability to get involved in something like this, or, venture upside. And so just the conversations, the excitement people were bringing, but also realizing we were making the organization stronger. Mm-hmm. So our strategy all along, one of our DNA points on our culture is to be crowd powered, in terms of like not trying to be the smartest people in a room, but hey, we'll have some smart ideas, but then let's go validate that with people. Let's validate that with the crowd. Let's get input. And so for us, crowdsourcing was a natural extension of our strategy. At the end of it, it may not have been the most efficient place to raise the capital we did, but we ended up with 1,000 investors in 50 something countries, like Barry said, with such diverse ideas and backgrounds and networks. They're actively part of validating and challenging our ideas. They're an active part of recruiting for us. They're an active part of turning up the volume when we launch a company. So it was a strength more than just the capital alone. Again, that made sense for us. If you're selling a B2B plugin for an AI application in the cloud, maybe the crowd doesn't mean a whole lot to you, right? So again, I do think that you have to look at strategy.
What were some of the factors that really made that campaign successful? Aside from us really working really hard and having a lot of wonderful conversations, I was like, that was one of the most exciting parts of this journey for me so far, is being a part of that crowdfunding campaign. It was just the momentum, the energy, right? So what were some of those factors in your mind?
Well, I think one of the things I'm most proud of is if you go back to our very first pitch when I was still in the garage, our story hasn't changed much. We have a vision. We have strong conviction on why we're doing it. Our why behind it is strong. We've led with our values, which has allowed us to have a very palpable culture. It's one thing you'll hear again and again that, people can feel it and taste it. I would believe that by doing that, you basically you're broadcasting to the world, this is who we are and this is what we stand for, and you attract the right people to the journey, right? So the byproduct of starting there was, Sajal is, fortunate to have you come along and then Barry and others. Like, our people are our greatest strength. And so I think really what we did on the crowdfunding is we led with those things. What's our story? What's our angle? Why do we care about this? So what's our why? And then we put our people up front, and we told our story often in every possible way we could. There was never a hard pitch. We're never that way. It's not in our DNA. We just like telling the story and what we stand for, and the right people are attracted to the journey. And I think in large part, that's all we just kept doing, and that's why it worked for us.
Yeah, and that's what we keep doing, right? And we've got some people joining us today. Dave Schultz, he's been actively supporting us and promoting even during the crowdfunding campaign. But even recently, Dave, thank you so much for, being so visible and supporting us. And we have Dan Friedenberg also joining us as well. So thank you everyone for joining us. Raising funds is really challenging, right? And a lot of founders, we deal with so many obstacles along that way. So Barry, what are some of the common obstacles that people face during their fundraising efforts?
Well, I think, for most people, depending on where they are in their journey, right? If they're a first-time entrepreneur, it's actually really difficult to understand where to start, right? There's sort of a wealth of information on the internet. I think every day there's probably a LinkedIn post that says, here's a list of 7,000 VCs that you can email and send your deck to. And, and it sort of feels overwhelming to a certain extent about where to start. And I think this is one of the things that we really provide to our co-founding teams in the studio, right? Like, we've done this numerous times. We've built systems that we know how to orchestrate and focus, and actually just get in the habit of continually reaching out to the right people, being able to identify them. We've talked a lot about this ideal investor profile. Like, we help people shape that, right? So if you're a B2B business and your ideal is that you've got a product that could be acquired or brought into a Microsoft or a Google or whatever, like how do you start to build a relationship with those people early so they're aware of you? Do you look for folks that are working in those companies that are potentially angel investors and reach out to them first? Right? There's ways that you can be very systematic. And that's how we prefer to do it. The other option is this sort of notional spray and pray, where you just tell the world, hey, I'm raising money, you should invest in this startup. And, every person is trying to reshare it. But we also find it can be difficult, right? You get diluted. So we're very systematic about how we think about these things step by step. And it is a process, right? You don't sort of raise money on your first phone call. You literally probably need to speak to 100 people to get 10 sort of, excited leads that may even convert to 2 or 3 investors. So I think I always try to encourage founders and say, don't get disheartened that if you do the first 10 calls and they're all no's, there's always something to learn from how you position your company, how you pitch it. If you can demo the actual product so people can see it working, especially in early stage companies, that helps investors sort of get on board. But it's going to take time, right? And you just need to think about that. You need to actually plan for it. You need to make sure that you have the ability to sort of work on fundraising, because as Mark alluded to, even when we did our equity crowdfunding, you're taking a huge amount of the organization's sort of horsepower, if you will, and you're focusing it on one thing, right? Which means you're sacrificing in other areas. So it's just being very deliberate about it, building the habit of it. It's almost like sort of setting aside a certain amount of your time each week to be continually doing it. Reaching out to new people, helping folks that you have in your pipeline, moving them along, and then closing, right? And that's literally, again, what we teach a lot of the co-founding teams that we work with, is systematizing this process of fundraising. So it just becomes a habit, something that they're doing every day, just like they're doing marketing every day, just like they're thinking about how to build their product each day. This is a really important part that they have to focus on.
Yeah, thank you, Barry. That's you identified so many different obstacles. I mean, the thing I hear over and over again when I talk to founders is not having the right connections or access to those networks, right? And so networking becomes a critical part of, getting introductions and meeting with potential investors. That's like a huge part of that challenge. But I always like asking you this question, Mark, is like, what are some of the lessons? Maybe you could share a couple lessons that we've learned from our fundraising efforts at Nobody Studios.
I'll just maybe broader from the studio. I think one of the things that I try to always share with when I mentor somebody or a new founder is that I think a lot of, especially first-time founders, but at any age or point in your career, people get wrong this idea that just because somebody's an investor that they're qualified for you or for your deal. And it's way more nuanced than that. It'd be like saying, I created a new skateboard and you're a consumer, so you should buy my skateboard. It's like, no, do you like to skate? Or are you capable of skating? Are you at the right age, demographic? Do you live somewhere where there's sidewalks and streets? Like, there's a lot of things that you can't just generalize. But I think in general, we do make that mistake when people say, well, that's a qualified investor. The reality is most investors have strong theses. And if you're a VC, you don't just have theses, you have theses that you've sold to a group of investors. They also raise money from investors, and they have bylaws on where they can invest and where they can't invest. So when you break that down, it might be, yes, they have a fund, but they are only investing in this stage of company, in this sector, and in this part of the country, or with this kind of threshold of revenue. So people walk away sometimes disheartened that they pitched a great investor and the person didn't bite. What I try to tell people is that most investors take somewhere between 200 to 300 meetings a year, and they're going to shortlist that down to about 20 that they like, and they might invest in 1 to 3. Why do they do 297 meetings they're not going to go anywhere with? Because that's part of their education process. It's part of them understanding what's going on in the market. Sometimes they might hear about a founder that just left another company that tells them that company might be laying off people, or there's a new wave of founders that might hit the market because people have hit a certain lockup period. The entire conversation is knowledge for them. But you can also ask questions. In an investor world, you're used to them asking questions. I mean, I usually try to lean in when I meet a qualified investor and say, well, what is your thesis? What is your target? What is your stage of company you like to focus on? How much is your fund? How much do you still have in dry powder? Meaning, how much do you still have to invest? What are your sectors? 5 of them. Okay. How many deals will you do? You'll do about 20 in the fund. How many do you have left? 6. Okay. And I'm in sector X. Have you already invested in sector X? Yes. Okay. Well, you're going to do 20 deals, 3 per sector, and you've already done 4 deals in my space. I'm dead on arrival. So that'll help you understand whether or not you're actually losing the pitch or you had no chance to begin with. And that shouldn't be disheartening for the founder. I say do the same thing the VC or the investor is doing. Use it to learn. What are they seeing in the market? What excites them about the deals that they're seeing? What deals have they already done? Is there something they learned since they did that deal that they would do differently? Like, it's also all a chance to practice your pitch. So, those kind of qualifying questions to me on the front end is something that a lot of people don't do. And it seems for some people uber sophisticated. And I'm like, it's just basic sales or marketing. You need to know what you're trying to offer and does it fit what the person wants? And if you do that to the next level, then you can target very specific profiles. There may be 8,000 people on a list, like Barry said, of VCs, but there may be only 42 that are looking for your type of deal. Man, put all your energy, effort into that, right? So when you're looking at LinkedIn and trying to figure out who knows who, and you're going to text somebody, you're going to ask for an intro, be hyper-targeted where you have the highest chance and likelihood of success. And even if you don't win that deal, the things you heard are going to make you even more prepared for the one that's a better fit down the road. So I just think people don't profile enough when they're trying to find investors. It's different when you're doing angels, early stage. But when you get into something later, be very laser targeted on the asks.
Yeah, thank you. And so I'm excited now because Barry gave it away earlier where we're going to introduce and talk about one of our new companies that we're building, Fundco. And so Mark, kick off this conversation. I know we only have a few minutes left, but I want to hear what was the inspiration behind Fundco and how is it going to make fundraising easier and faster and more efficient for everyone?
Well, this is a technical term, but fundraising sucks. I chuckle that, as much as we've learned in our collective knowledge of our team, I think it's as hard as it was when I started my career. It's just a lot of inefficient effort. Now, I often say in podcasts that fundraising is a huge part of learning your market, your fit, your pitch. It's important. But that's maybe only 10 or 20% of the fundraising effort. The rest is just a lot of money chasing dollars. So I think it's inefficient. I think, like you said, there's a lot of fascinating emerging founders and different, socioeconomic backgrounds, even different countries that don't have the access to the networks that maybe somebody later in their career or from a different background might have. So I think there's a lot of really great ideas and possibilities that are not finding investors. So I think it's always been hard. I think it's just as hard. I think there's a lot of people who aren't finding those opportunities. I always say VC tends to follow like sheep. So there's like a theme, like, oh, we're doing Web3 this year. And then in 13 months, like, oh, Web3 is so dead. Now we're doing crypto. And then in 13 months, oh, crypto's dead. Now we're doing, and it's like, you don't time your market perfectly. You're either too early or you're late. And there's no way that's right. So I also like the democratization of funding. So I think it's important that it hasn't quite happened yet with all this adversity and all the opportunities we talked about in the beginning. Nobody's really made it easier to raise capital yet. And so Barry hinted on one of our strategies internally is to do what we call machine of machines. So anytime we see something repetitively we have to do for our companies, it could be a marketing function. It could be, how do you split one piece of long form content into 100 pieces of social content? Anything we know we're going to do again and again. If we don't find a tool or a provider in the market that does that for us, we immediately ask ourselves as a creator of companies, could we create a problem to solve our own problem? Or could we create a company? If we can create a company to solve our own problem, then it's probably a company that has commercial viability that we could take to customers and scale, get its own funding. And it's part of our strategy to make sure that we reduce our cost centers and make us more scalable as a studio as well. So that's what Fundco means to us. It's in the early stages. We're playing with a lot of different strategies, but it means we should be able to cultivate a list of people knowing the kind of deals they like, the stage, the profile of founders, the locations, the sectors, and build our own credibility as a studio with those groups so that when we reach out to them and say, I know what you like to look at, and I think this is a fit, please take a look at, we can cut through the noise and get a fair shake at looking at our deals. And as we develop that for our own purposes down the road, we'll be able to open that up for, the right types of other companies that might be outside of the studio.
Yeah, I love that. And Barry, I'd love to hear from you if you can share a little bit more about, are there like specific tools or resources that Fundco is going to be providing? And then how does it support scalable fundraising efforts? And then more importantly, how do startups get involved with Fundco? Because I'm seeing more people signing on. And so I'm sure people are wondering, like, how do we get involved with where Fundco is right now?
So first of all, the fun thing about Fundco is that we are trying to bring fun into the funding process. That's one of the reasons we've called it a Fundco. What we will be doing is sharing everything we're learning, right? So I know there's loads of great followers of The Making of Nobody, and we'll definitely with Fundco be sharing our own journey and do events like this. So I'd really encourage people, follow Nobody Studios, make sure you subscribe. You'll hear us do lots of these events in the future. Some of the lessons that we've learned so far is, our first initial customer is startups in the studio. So we have a fantastic portfolio, companies like Avalify, ThoughtFormer, WebDelix, Ovations. All of these businesses are starting to raise external capital, and some of them have already started to do it through the Fundco mechanism, right? And this is, again, a great sort of first set of customers for us, if you can imagine. Right, we're still a business. We have our target customers, which are early stage, sort of 0 to 1 companies that are ready to start, looking for external capital. So the process we go through with each one of them is helping them identify who's your ideal investor profile. And then where are we going to find that sort of community that we can reach out to them? What's the best way that they look for information? Where do they look for new deals? Navalify is a great example of that, right? It's this idea of being able to get insights around intellectual property and patenting by just uploading a pitch deck. And suddenly you have this investment decision insight. So the places that we've started is simply like looking at places where intellectual property lawyers are, where investors are, and actually sharing with them and showing them the product has actually been one of the biggest steps, because it's one of these fundamental things that actually blows their mind, because they sit there and the team upload a pitch deck that they can send it like the moment of the pitch. And it shows the actual processing happening and the result happens on the call. So investors are like, this isn't smoke and mirrors. This thing actually works. And they get surprised by how much cheaper, faster, and higher quality it is. Right. So that's an example for us about the methods that we try to champion is do real demos when you're actually speaking to investors, because that gives them this magic moment. And with something like Navalify, where investors show up with a pitch deck and they sort of upload it in real time and get real-time feedback, it just blows their mind, right? And so this is the kind of like little tips and tools that we try to bring into Fundco about how we operate, even as Nobody Studio companies. So there's lots more that we can share. So what I would, again, encourage everybody, subscribe to the channel. We'll be doing lots of events for Fundco. And if you want to learn more, we're doing lots of great things. We've got a great list of preferred investors to get access to our deal flow early. There's so many exciting things happening, and I'm sure we'll be back again, Sachel, to share and be on this show with some of the things that we're doing.
Awesome. Is there anything else you want to add, Mark, on this topic? I know you were like nodding your head, and I can't wait to see where Fundco goes, because honestly, I would love to learn for myself. How do you do this? Because going through this journey with Nobody Studios, I've seen the benefits and I've seen the challenges, right? And so if we can make that easier for founders, that's going to be a game changer, right? So Mark, do you want to add anything else before we sign out for today?
I thought Barry said it great. I mean, the only thing I would say is it's easy to hear what we're saying and think that it's all systems and processes and things. Yeah, Dave. My favorite part is we always say that sometimes the fundraising process is like a clown show. So Barry named it Fundco with a D, and he put a little clown symbol. I think it'll be our logo. So I get a chuckle about that every time. But yeah, I was going to say there's a lot of systems. There's product. There's productization of this we're talking about. But the thing that could get lost is at the end of the day, one thing I don't think is going to change dramatically is at the end of the day, relationships will cut through the fog. So when people that you like and trust, you've had a chance to listen to, learn, build relationships, whether it be 2 or 3 months into a relationship or 30 years, that's how really big investments happen for the most part. That's how small and medium-sized investments cut through the fog. A lot of angels kind of travel in groups. 4 or 5 people might invest together because somebody went really deep and said, I like it. And other people will make a faster decision. So we're trying to build that into Fundco as well. So it's not just a database. It's spending time with the investors and understanding the profiles that they look for, the things they like. And you can capture some things that people won't put in a spreadsheet, to be honest, or won't put on their profile. But some people will say, I'm a Princeton guy. I never invest in Harvard people. Like, fine. Those are things that you're able to connect the dots on. Or somebody might be an avid investor, but they're also a pilot and they love fly fishing. And guess what? You got a founder who fits their profile and is a champion fly fisher. Like, these are kind of the dots that you connect in a CRM system that really kind of helps you capture the relationship in a way that cuts through the fog and just adds velocity to a deal being considered.
Awesome. Well, thank you so much, both of you, for joining us today. And as you heard Barry say, follow us. There's going to be a lot of exciting things happening with Fundco. We're going to be doing regular events, so you can follow us on LinkedIn, and you can watch all of our prior live streams on the YouTube channel at Nobody Crowd. Thank you, everyone, for joining. Scott King, thank you so much for joining, and thank you again, Dave, for being here. All right, everybody, we'll see you next time.